Tuesday, December 10th, 07:58 a.m. New York time. Welcome back, investors, to Winning Wall Street's Money. We are approaching an event I've been sharing pretty much weekly. It's an event, binary event, meaning it's a schedule. It's public information. The event is the Central Bank of the United States, aka the Federal Reserve, a separate federal agency, will be having a meeting to vote on changing or leaving unchanged the overnight lending interest rates. As well, they were doing a press release talking about the current situation and the upcoming situation on their opinion of data they have on the economy, of why they make this decision at this point in time and what they're leaning towards coming into the next meeting. Wednesday, December 18th, 2 p.m., that number will be released, as well as their press release. I recommend reading it instead of just listening to it. Do both. That being said, going straight to the charts of the U.S. Treasuries. Again, U.S. Treasury Department is another separate federal government agency. Both the heads of the U.S. Treasury Department as well as the Federal Reserve are voted on by the United States Senate. And they have term limits in those positions for those federal agencies. Right off the bat, we'll look at the higher yield, the 30-year yield. And this is a 20-year chart. Each candle is a month. But again, it's a 30-year yield. We're currently at. So right here, top, you can see the price. And look, back here in 2007 was the high for the 30-year. And here's the low, 2020. So we're inside a range, much closer to the highs. We're also inside the range of last year. Here's the high of last year. Here's the low of last year. And here we are right now. Huge consolidation, trending down. Okay, so that's a longer duration. If you happen to buy the 30-year U.S. Treasury, that's, again, right here at point in time, that's the yield you'll receive, aka interest rate. Much higher than down here. So again, if you're looking for a fixed income financial product, it's better to be buying here than down here. Why would you want to lock yourself in 30 years for a lower rate? The 10-year. Here's the high. Here's the low. Same thing. Very close to the high, as well as we're inside the range of last year, currently trending down. Big difference now. Now we're on the 5-year. Here's the high for the past 20 years. Here's the low. Same thing again. Much closer to the high and inside the range of last year, but trending down. So that was a 30, the 10, and a 5. Here on the 2-year yield, here's the high, here's the low. Same thing, very close to the highs. But the difference here is this was the low of last year. So we did break the low of last year, but we didn't take out the high. So again, the shorter term one, the 2-year one versus the 30, 10, and 5. The reaction is much more faster of lower yields. So the shorter duration, right here, you earn less, but you're less exposed for a duration. So if you want to earn less, you go to the shorter term. If you want to be in the fixed income product for lower term, you go to the lower term. Again, I would not recommend, and I am not locked into long-term ones, but I do like the dollar cost average approaching on the 1-year ones. I'm not posting them here because they change so rapidly, the 1 year one, so you just locked in for 12 months. Not all the capital. A nest egg. I want to take this to the next duration. Again, remember this, the 2-year one. Okay, I wrote that. But I'm going to take this to the different time frame where we'll look at the 5-year charts and the weekly versus the 20-year. So this is a 5-year chart. Each candle's a week. And this is that 30-year yield. Back here, 2020 was accumulation. 2021 accumulation, as well as markup. 2023 accumulation, markup. The high of 2023 distribution, markdown, huge consolidation, building a lot of energy in here for the next trend. Yeah, distribution, smart money selling, accumulation, smart money buying. Where do you put yourself in? So again, I'm expecting the yield to continue going down this time. The 10-year yield, here's the low for the past 5 years. Here's the high. Again, this is the 5-year chart. The shorter duration, same thing, accumulation, distribution, distribution. The 5-year yield, here's the low, here's the high. Notice the 5-year, a lot more consolidation here. Markdown phases. Let's take it down to the shorter duration, the 2-year yield. 5-year chart, 2-year yield, each candle's a week. Last year, distribution. Again, I told you we took out the low of last year already. I need to update this. I actually made a lower low since I went to the chart last. Just a minute. Already coming unprepared. Shame on me. Knocked me from a vacation. There we go. So overall, you see they all are on currently markdown phases. Well, if people want to earn higher income on fixed income products, there's other things. These are the U.S. Treasuries. Some of the other ones taking consideration are muni. Yep, muni. Municipality bonds, state, county, city. Or if you want to go into something more aggressive, higher risk, that'd be corporation bonds. From the government to the private, different kind of risk. And understand, when the federal government wants to raise capital, it can offer higher interest rate at those treasuries and then monetize more people to buy them. Well, in the private sector, corporations that pay dividend, those are income stocks. They're not necessarily growth stocks. Those companies raise interest rates on their dividends to attract buyers of the stock. And then you would have the income from those dividends on the stocks. That does not necessarily mean that stock price is going to go higher. So you could take a loss on that. But if you're a long-term investor and that company does perform outstanding well long-term, well, then you get the benefit of a dividend. That dividend is not going to invest in the company to grow the company necessarily. It's paying it out. That's why they're not considered growth stocks. Just some insight here to be situational awareness when you're looking to earn income. And I discuss that a lot more on my Patreon page of earning income. 70% chance of success using options. Options are a derivative. But again, the lower risk is in the U.S. Treasuries. And you earn less income. So if you want to buy U.S. Treasuries, go straight to the source, USTreasury.gov. You're not going to pay a broker for those fees, nor a banker. like early access to my video. Links below in the video. Thank you as always for spending just a little time with me. That's it for the video. Thank you for watching.